The next question we're going to dive into is PQ8-5. You purchase equipment and have the following information. We have the cost, $133,500. We have the date that is ready for use, January 1st, 2016. The estimated useful life, 5 years, and the residual value or the salvage value. We'll just stick to the residual value going forward now. 13,500. So the first thing I want you guys to always do is write down the date. Very important. The date is January 1st, 2016. And remember, this is a date that is ready for its intended use. We want to write down the date because we want to see if we had it for the full year in the first year of operations. Yes, we had it for the full year. In another question, I will show you guys how to tackle it if we didn't have it for the full year, but in this case we did, so it's much easier for us. Then remember, the straight line method formula, always write this down as well, is cost minus residual value divided by the useful life. So the cost given to us in this question is $133,500. The residual value, remember, the residual value is the value that it's worth or we can sell it for at the end of its useful life, and this is an estimate. And the useful life is 5 years. So we're going to use it for 5 years. So the first thing we're going to do is we're going to calculate the depreciable amount. The depreciable amount is simply going to be the cost minus the residual value. Simple as that. How much are we going to actually depreciate it? So this one is going to be $133,500 subtracted by $13,500. Simple as that, correct? Then we're going to calculate the annual depreciation. We're going to take the depreciable amount, $120,000, and we're going to divide it by the 5 years. So $24,000 per year. Next, we're going to calculate the monthly depreciation. Even though we established we had this for the full year, we don't really need this for this question, but we'll still answer the question at hand. Remember, there is 12 months in a year, so we're going to take the $24,000, which is the annual depreciation, the yearly depreciation. Annual means year. Annual, yearly means the same thing, and divided by 12. So it's $2,000 per month, but we already established we had this for the full year. So let's complete the chart now. So the depreciation expense for the first year is going to be $24,000. Remember, accumulated depreciation, it tells you in the name what it is. It's depreciation that we're accumulating after every single year. This is the first year of operations. We don't have any depreciation in the prior years. Not the first year of operations was the first year that we bought this piece of equipment, so we didn't depreciate anything in prior years. We never had it. So it's just going to be $24,000. To calculate the book value, remember the book value equals to cost, which is $133,500 minus accumulated depreciation for that year. There you go. So the cost is $133,500 minus accumulated depreciation for that year is $24,000. Simple as that. Now in 2017, we had it for the full year again, January 1st, 2017 to December 31st, 2017. That's a 12-month period, $24,000 again. Now the cumulative depreciation is going to be $24,000 of what we had in the prior period, plus $24,000 that we actually depreciated in this year. So $48,000. Now the book value is going to be $133,500, cost minus accumulated depreciation for this year of $48,000. $85,500. Now once again, we had it for the full year in 2018, $24,000. Accumulated depreciation is $48,000 plus $24,000, and now the book value is $133,500. The cost minus accumulated depreciation for third year or 2018, $72,000. As you can see now, there's a pattern, correct? Once again, $24,000. Cumulative depreciation is $72,000 plus $24,000. Remember, we had $72,000 in accumulated depreciation from the prior 3 years. Then we're adding another $24,000 in the fourth year or 2019. Now the book value is 133,500 minus 96,000. And once again, in the last year, 24,000, 96,000 plus 24,000, and now 133,500 minus 120,000. Now I want you to look at this. So the cost is 133,500. Residual value at the end of its 5-year useful life, 1, 2, 3, 4, 5, is going to be 13,500. You could double check your work because residual value should be equal to the book value at the end of its useful life. Okay, now let's keep going and let's record the depreciation expense for December 31st, 2016, December 31st, 2017. So January 1st, we know the equipment was 133,500 and accounts payable is 133,500 because it says that we purchased the equipment. Since it doesn't tell us if we purchased it in cash or not, we're going to assume that is accounts payable. Then at December 31st now, our accumulated depreciation is going to be the 24,000. Let me color code this. So at December 31st, our accumulated depreciation is being negative 24,000. It's being negative 24,000 because remember, it's a contra account. So even though accumulated depreciation is increases as a negative because that has a negative balance altogether. That depreciation expense is going to be 24,000. Simple as that. Now the balance is just going to be 133,500, then negative 24,000, 133,500, and 24,000. Okay. Now the beginning balance, I'm going to take it directly from the ending balance for 2016 because this is a balance as of December 31st, 2016. That's the end of the year. The very next day is January 1st. Now that's the beginning balance in 2017, correct? So 133,500, negative 24,000, 133,500. And remember, so at the end of each year, revenues and expenses are restarted to 0. Very important. So these are part of the closing entries. So that means that the beginning balance for depreciation expense is going to be 0. Now we're doing another adjusting entry for depreciation. Now this balance is going to be 24,000 again. So now accumulated depreciation, once again, is going to increase by negative 24,000, 2017. And depreciation expense is going to increase by 24,000. So at the end of 2017, we're going to calculate the balances again. In this case, once again, we're going to add the negative 24,000 plus the negative 24,000. It's just going to be 133,500 and then 24,000. And as you can see, at the end of 2017, the accumulated depreciation matches this balance over here. Don't let the negative trip you up because remember, accumulated depreciation is a contra account. That's why it's negative. But a negative balance is a good thing for accumulated depreciation. It just shows you that it reduces the equipment account. That's it. Now, the last question is, show the balance sheet presentation for December 31st, 2017. So once again, we're going to have a 3-part title. No company name is provided, so we're just going to write company name. It's going to be the balance sheet, and we're going to do it for 2017. Very important. So December 31st, 2017. So we're going to have property, plant, and equipment. Then underneath this, we're going to have the equipment, which is going to be for its cost at 133,500. Then right underneath it, we're going to have accumulated depreciation, which we established it is negative 4,800. Then we're going to simply do a calculation. We're going to do 133,500 plus negative 4,800 to get 85,500. And this gives us our net book value. Net book value is very similar to the net realizable value, which we've been using in prior chapters. This is different terms for it. And as you can see, the net book value of 85,500 as of 2017 is the same value that we have in our chart for 2017, 85,500 book value. So that wraps it up for this question. This question is very important. I highly suggest that you guys go back and redo it a few times and learn the actual material.